Thank you for everybody that's tuned into the webinar today. It's a pleasure to be able to talk about a topic that I love so much, which is how to invest money. And as the title of this seminar says, this is going to be on how to invest money like the major prestigious academic institutions of our nation and how those endowments have decided to place their resources. Today's agenda, we're going to start off with this topic of asset allocation and risk and return, how the endowments allocate their assets. And then we're going to talk about traditional versus alternative investments, talk about stocks or equities, bonds, and last of all, bring it to a closing with some summaries about the effectiveness and power of diversification. Investment performance is primarily driven by asset allocation. What we mean by asset allocation is it's the big picture of a portfolio. Does the person have mostly equities? Do they have bonds? Do they have cash? It might be subdivided further, not just how much do they have in equities, but we might break it down into is it domestic or international or even further divisions than that. And what we find is that especially long-term investment performance is driven by that decision. In other words, it doesn't matter so much which stocks you pick or which bonds you pick in terms of whether your performance is exceptional or poor. It's primarily driven by which buckets you put your cash in, so to speak. And of course, this asset allocation decision, like so much in investments, is driven by this balance between risk and return. With higher risk, we're trying to get higher return, and you want to keep a balancing act there. But the one thing in which we don't have a balancing act about is diversification. Diversification is a wonderful ability to enjoy lower risk without investing, without having lower return. So let's take a quick example of what I mean by diversification. If you bought one bond with a yield of 5%, then in some sense you could say, well, I'll have an average return of 5%, but I'm taking this risk that this bond could explode and I would lose all of my money or most of my money. But if you simply invested in 20 or 40 bonds, all that have yields of 5%, you'd see that your risk of losing a tremendous amount of money would go down because not all 20 or 40 bonds would explode at the same time. So diversification is that wonderful thing that enables us, as it says there, to reduce our risk without reducing our expected return. And diversification is what the largest endowments here, the ones with over $1 billion, if we look across these categories, instead of being heavily weighted in domestic equities and fixed income and even international equities like the smallest funds are, the larger funds have a pretty substantial portion of their money in alternative investments. And you can see that as you get smaller and smaller as an endowment, they put less and less of their money into the alternative strategies. And the goal of the alternative strategies is to give us diversification. They're trying to seek more stable returns through a more diversified asset allocation. Well, let's back up to the question of what is an alternative asset, and to define what an alternative asset is, it really helps to talk about what's a traditional asset, because most assets are either traditional assets or they're alternative assets. Traditional assets are usually thought of as being long positions in equities. Now by equities it's simply stocks, whether they're domestic or international. By long only, what I'm talking about is the idea that this is an investment program in stocks, that you're purchasing the stocks. You're not short selling the stocks. When you purchase the stocks, you buy them, you hope that they go up, you lose money if they go down. But we're going to talk a lot later today about short selling. And short selling is taking a negative position in equities or stocks. It's actually selling a stock at, say, $20 and losing money if it goes up and making money if it goes down. That's part of an alternative strategy. A traditional strategy would simply buy the stocks, and whether it sells them, after a few months or a few years, it's a long-only strategy. Similarly, you can put your money in bonds, fixed income securities, long-only, and of course you can hold cash. And when you talk about cash here, I'm not talking about currency. I'm talking about money market mutual funds, short-term certificates of deposits, very low-risk short-term securities like that. Now, traditional investments are in contrast to alternative investments, and I'm showing three big buckets of alternative investments here. So The one on the left here is hedge funds, and also we would include managed futures in that. These are skill-based strategies. They are generally very actively traded, sometimes with a lot of leverage, but the idea is there's a lot of skill being applied to try to not just buy stocks and hold them, but to buy the stocks that are going to go up, they hope, short sell stocks or other assets they think that are going to go down, to perhaps hedge the risk between those two positions, and do that in quite sophisticated approaches. Another major category of alternative investments is real assets. And when we talk about real assets, we're talking about investments whose underlying performance is going to be driven by the assets that they own. That's in contrast to, for instance, the operating firms that we're so familiar with, the General Electrics and Googles and Apples of the world, where their performance is so much driven by product innovation and managerial efficiency. In the case of real assets, the performance is being driven by the underlying assets. If you have a large investment in for instance, timberland or farmland, how well your investment is going to do is mostly driven by the commodity prices that underlie that, the crop prices, the timber prices. And that gives it distinct characteristics that, that many people find attractive in their portfolios. And the last big bucket we're going to talk about is private equity. And private equity, some of the investments that can include in are leveraged buyouts, venture capital, and even products like distressed debt. There are other categories of alternative investments, such as structured products, and it's difficult really to define exactly all the things that alternative investments can be. But that gives us a pretty good start on the sort of investments that we're talking about when we talk about diversifying away from traditional investments into alternative investments. And I think a starting point for understanding the case to be diversified is to take a look at the equity markets and the bond markets. And that's what we're going to turn to next. Equities are a great asset, and this diagram shows, it covers 2 centuries, and it shows the incredible general upward swing of equities. If you notice this axis on the left-hand side, it's not going up by equal dollar amounts. Each line represents a 10-fold increase in money. And you see that in the first 30 years or so, the value of the equity market went up 10-fold, and it did so again in the next 30 years, and it went up 10-fold again. So over a period of 100 years, it goes up 100-fold. Excuse me, 1,000-fold. And over another 10 years, it goes up 10-fold. Excuse me, over another 30 years, it goes up 10-fold. Over this 30 years, it goes up 10-fold. And over 30 years, it goes up 10-fold again. So over this century, it went up 1,000-fold. This is just a tremendous increase, and we can't, even if it's 2 centuries, we can't conclude that the future is going to be like the past. But this gives us great confidence that equities are a class that we want to have in our portfolio. But we need to take that tremendous growth with a sober realization of how bad equity markets can be in the short run. So I'm going to talk about 3 periods that should inform us about putting too much of our money in equities. The U.S. stock market in the Great Depression, the recent internet bubble, and the Japanese experience. Let's go to the Great Depression, which began in 1929 and lasted for a decade. From the high in the stock market right before the crash of 1929 to the low area that it reached as the Great Depression really reached one of its lower levels, we see almost a 90% decrease in the stock market. And by the way, this is not a 90% decrease in a particular subgroup of stocks that were punished badly. This is the huge decrease in all of the stocks and the blue chip stocks that were in the Dow Jones Industrial at that time. It's sobering to think about the idea that a person in 1929 who perhaps decided to retire because their portfolio was doing so well, if their portfolio was 100% invested in stocks, they would have lost 90% of their wealth over the next 3-year period. That's a level of loss that's just not acceptable, of course. And we might think that the times have changed and that we could never experience such a bad equity market as that. And there's a possibility that that's true, but I certainly don't think it's true. So let's turn to a more recent episode. Now, this is not the overall U.S. stock market, but it's a large component of the U.S. stock market. It's the NASDAQ. And if we look back into March 2000, we see that the NASDAQ was over 5,000. And within the space of a little over 2 years, the NASDAQ had fallen to a low of approaching 1,000. That's probably about a 75% decrease. So this wasn't the overall market, but it shows the incredible losses that occurred to those people that weren't well diversified, those people that got caught up in the bull market of the late 1990s and the excitement of making so much money in some of those internet stocks and the devastating losses afterwards. But to me, one of the most sobering examples of what can happen in equity markets is the Japanese experience. We're looking here at the Japanese major index. This is equivalent to our S&P 500. It's the major Japanese stock index, and it shows that going into the year end of 1989, the end of the 80s, the Nikkei had almost reached the level of 40,000. And it eventually hit a low of 7,000, which of course is a decline of more than 80%. And even to this day, it remains down below the halfway mark. So 25 years later, people that invested, Japanese citizens who invested in a very well-diversified stock fund within their country, 25 years later, they're down over 50%. I believe that's possible in this country. Again, I want to say that I am positive about stocks. I'm in particularly positive about the U.S., but we're at some very high valuations, and it absolutely is possible that 25 years from now, we could look back and see our stock market at half of the level that it was been at. This is a devastating loss. If you had your whole pension portfolio in this index and you had to withdraw money to live on as a retired person, when you reach this level, you could actually run out of money as opposed to waiting until it starts to come back up. So the bottom line on equities is great return, but also great risk. Let's switch over to bonds. Bonds offer us a little more safety than stocks, but it is not clear there's a tremendous level of safety. I think we've been lulled into some false complacency over the past 30 years. The long-term history of bond returns, and by that I'm talking about going back a century, is that, as it says here, very short-term, very safe fixed income investments. And here I'm talking about bank accounts, money market accounts, short-term certificates of deposits. They have not kept up with inflation on an after-tax basis over the last century, or they've been approximately zero. In other words, if you put your money in cash all throughout the last 100 years, after paying income taxes on the returns that were trying to keep up with inflation, you would not have kept up with inflation. Now, you can invest in a longer term, take some longevity risk, and then the evidence indicates that you'll get a small reward, especially getting out to at least a maturity of 1 year. And you can get some reward for taking credit risk. But let's look at where we stand right now. The U.S. Treasury rates I'm showing here is the 10-year Treasury rates over the last 40 years or so. And in the 1970s, there was this tremendous run-up in interest rates until around 1980. And actually, I think they broke in July of 1982. And then we get this long downward trend. It's amazing that all through the 1980s, after 1982 at least, we saw a general decline. We saw it through the 1990s. We saw it in the first decade of the new millennium, and now we're seeing it in the second decade of the new millennium. So most of us, I do remember the 60s and 70s, but most of us have primarily invested through 3.5 decades of incredibly downward trending interest rates. And the reason that that's important is because there's an inverse relationship between interest rates and bond prices. When interest rates go down, bond prices go up. So what this means is that what we've noticed in the last 30 to 40 years, which is very nice bond returns, not incredibly exceptional, but very nice bond returns, has been driven by a historic decline in interest rates from the teens, almost approaching 20% for the long term for some yields, all the way down to our current yields, which are almost 0 for cash, 1% for maybe intermediate ranges, and 2% for slightly longer ranges. I want to talk for just a few minutes about what an interest decrease could do on a go-forward basis. We see that this huge decrease in interest rates has driven bond prices upward. What would happen if bond prices, if interest rate to bond prices, if interest rates were to go upward? Well, I start in this analysis with a 2.5% yield, which happens to give us this particular price for the current 30-year Treasury bond. And the question that we're asking here is if immediately the long-term yields rose to 3%, that's just a 0.5% increase in yields, what would happen to your bond price? And the answer is it would drop about 10%. And I think a yield jump up to 3% is something that could easily happen. If it were to jump to 5% or 7 or 10%, we could see losses in very, very long-term treasuries of 40, 50, even 60-some%. And this actually happened in my memory. Back in 1973 and 1974, long-term treasury bonds had very low coupons because we were in a relatively low interest rate environment. And then interest rates, as we saw in the previous diagram, began to rise. And they rose so quickly in 1973 and 1974 that investors in treasury bonds who had never seen a major decline in treasury bond prices, those investors lost up to 40% of their money in a short period of time as these interest rates soared. And I think we could certainly experience that again. I happen to not be horribly pessimistic about that. I think that interest rates are going to be low. I don't think they're going to stay this low, but I do think they're going to stay low, and I think it's appropriate to have money in bonds. I'm not trying to say anything else, but I am saying that the downside for bonds, for bond prices, the upside for bond yields is much, much, much bigger than the other direction. We could get massive interest rate increases, but we can't get massive interest rate decreases because interest rates are near 0 already. So I think that bonds should be part of a portfolio always, and I think at this point they're maybe a little less desirable than they've been in the past. So where does that leave an investor? I mentioned how dangerous stocks can be, but great long-term returns, bonds, good safety to some level, but really modest returns maybe go forward. And cash right now is just abysmal because you earn less than 1% to be in cash. You pay income tax on that privilege, and the inflation rate is likely closer to 2% if we're lucky. So you're actually losing money in cash. So where does that leave the investor? And I think that what the institutions are saying when they make their major allocations to alternatives is we need to look elsewhere. And elsewhere that we can look at is managed futures. And if you see this index that's in kind of a, I guess that would be a brownish burgundy color here, that is the cumulative wealth that one would get from investing in the 50 largest managed futures. Now, managed futures are like hedge funds. These are investment pools where the managers are trying to make decisions as to which futures contracts are going to go up, which ones are going to go down, and they take offsetting positions or concentrated positions in an effort to be in the assets with long positions that are going up and be in the assets that are going down with short positions. So that's how they try to time the markets. Now, they're not perfect at timing the markets. If you look at the beginning of this diagram, we actually see a period here where managed futures weren't doing very well, and then when the stock market goes very badly, and the red line is the stock market, the S&P 500, the managed futures have a really good run. And then here's a time period where both of them track upwards together nicely. Managed futures moved, but we see this huge crash in the stock market during the recent financial crisis, but managed futures continue to do well. Why? Well, managed futures were not necessarily long stocks. They might be long oil, they might be short oil, they might be long currencies or wheat contracts or gold. They're taking these positions and they don't necessarily move with or against the stock market. They move rather independently of the stock market. And that's the key to diversification, is to buy assets that don't move together. That's what diversification is all about. If we look over the past 5 or 6 years since the financial crisis, managed futures have kind of held level and the stock market's had this huge run-up. Now, how does that, what caused that? And the answer is that many of these managed future strategies did not perform well in the rather in the market conditions that we've had over the past 5 years. But in my opinion, they are going to return to doing what they've done in the past, which is on average through time producing positive performance. The thing that I like most about this diagram, and really the reason that we ought to be thinking about getting involved in these sorts of investments, is this gray line in the middle. The gray line in the middle is a 50-50 blend between the stocks and the managed futures. And what that means is it shows you what would have happened if you'd put your money in each index, in each investment, half in this investment, half in the futures, and half in managed futures, and half in the stock market. And what we see is that you would have gotten the same final performance, but you would have received it with a lot less volatility. And that's the key to diversification, and that's where we think investors should look, especially in this environment of very high stock market valuations and index levels and very, very low bond yields. Investing in alternatives is something that I've believed in for many years, and it's been a pleasure for me to become involved with Tyler Vernon and Biltmore Capital, because that's something that they've also believed. And I think that's going to be a great portfolio to have on a go-forward basis, is a portfolio that diversifies as fully as possible by including non-trivial allocations to alternative investments. Before I talk about this last slide of diversification, I just want to add that it might be a new concept to some people to think about these strategies, and this is just an introduction. I did not get into detail about those strategies, but I remember back in 1980 or so, very few people really thought that small stocks should be part of a prudent portfolio. Institutions avoided very small stocks because they didn't think they were time-tested. In fact, if we go back 100 years, you'd find that institutions like pension funds would not even invest in common stocks. They would only invest in preferred stocks and bonds. And by 1980, they would invest in large and medium stocks, but they wouldn't invest in small stocks. And that was fixed, and beginning in the 1980s and all the way through the 90s, investing in small stocks has become part of the investment landscape that institutions and others feel comfortable with. So I would end with the classic line of the three most important things in investments being diversification, diversification, and diversification. It's a way to reduce risk. It is a free lunch. It's this idea that in so many areas of asset allocation, in order to get lower risk, you have to sacrifice return. But that's not true if you're diversifying. You can lower your risk without lowering your expected return. And I believe that diversification is appropriate in almost all circumstances. A lot of people avoid it, and especially we find that when economic times are really, really good, people look and they see all the money being made in individual stocks and stocks as a whole. And a lot of people abandon diversification when the stock market is doing really, really, really well. And of course, that's the last time in the world to become poorly diversified, is when times are really good. And similarly, when times get really bad, people become very discouraged. Assets are at an all-time low, and that's a time when people begin to become too conservative because they've experienced such pain in the recent time periods. I believe that we want to diversify consistently through time, and we don't want to try to overly time whether we think a particular sector is going to go up or down. I hope this has been a useful introduction. I realize I haven't gone into a great deal of specificity with regard to alternative investments, and I'd be very happy to field questions that anybody might have with regard to what these alternative investments look like, and maybe talk some more about that, or talk about anything that any of you would like me to respond to. But I thank you for listening so far. Well, that's a very difficult question to answer precisely. Let me explain the history really of what's gone on with alternative investments. And that is that in the past, by that I mean the 1990s and 1980s, many alternative investments were really the purview of the very wealthy and the very large institutions. And they did this with private placements, with limited partnerships. And to get involved in those products takes, in my judgment, a tremendous amount of due diligence and sophistication. But what happened, especially in the last 5 years, is that the SEC became wise to the idea that investors needed more alternatives than the standard traditional mutual funds that were available. Mutual funds are a great investment vehicle, but mutual funds were focused by SEC regulations, largely speaking, on traditional strategies. You couldn't implement alternative strategies in mutual funds. So the SEC changed the rules, allowing firms to be more flexible and to bring some of these strategies into the mutual fund space. That's great, because that means that the ordinary investor can invest in these products, and they're more regulated, and they're more constrained, and I think that it's much easier to evaluate these alternative investments when they're inside of these mutual funds, rather than trying to evaluate them when they're limited partnerships, where they're privately organized investment pools that are available only to the wealthy and the institutions. But with that came a large number of these mutual funds. It seems like everybody is dragging out a new idea for a mutual fund and is marketing it. So how do we differentiate between, how do we understand the difference between the different strategies that people talk about: equity market neutral, credit long short, merger arbitrage, convertible arbitrage? How do we even understand what's going on, and how do we make an evaluation that if you're going to pick a particular type of mutual fund, such as one that has managed futures as an underlier, how do you differentiate between the funds? Well, what we often do in the traditional mutual fund spectrum is we look at long-term return histories. Well, the problem here is that the mutual funds themselves do not have long-term histories. So it's a difficult issue. One of the things we can do, I think is important to look at, is to look at the fees that the mutual fund charges, the alternative mutual fund charges. And the good news is that alternative mutual funds have much lower fees than hedge funds. Hedge funds tend to have very large fees associated with them, and many of the alternative mutual funds have rather modest fees. That's good. Another thing that I like to look at, excuse me, is the management of the company, of the mutual fund. Are the managers of the mutual fund experienced in the alternative sector, or are they new to the alternative space? And obviously you want an investor who's got a good track record in alternative investments for a long time period. So the ideal alternative mutual fund to me is one that has a management team that for many years was very successfully running the private hedge funds, and now they're taking that experience and that strategy and they're moving it over into these publicly available mutual funds. So what I look for in managers, and I spend a lot of time doing this, of course, is people who really understand the strategies, they're experienced in those strategies, they're charging moderate fees, and that they are following a strategy that makes sense in the current environment. I think that they're all appropriate for some investors, but for the ordinary investor that I'm thinking about right now, a person like myself perhaps that's accumulated their retirement plans, and it's very important that they receive safe but reasonable returns on those investments. I certainly think that taking an asset allocation and putting 20, 30%, something like that, into alternatives can be appropriate. The question is the question that's been asked and is appropriate is, well, I listed 3 major categories. One was hedge funds and managed futures. Do I think that's appropriate? Absolutely. That's where these 1040 acts are coming out. Excuse me, they're called 40 Act mutual funds. These regular mutual funds are coming out, and that's a great way to invest, managed futures and hedge funds. Also, in the real asset space, we can get involved with MLPs, and we can get involved with REITs. Now, some people would think that REITs, real estate investment trusts, have been around so long that they're really not traditional, and I wouldn't necessarily disagree with that. It's just a matter of semantics. But if you don't have REITs in your portfolio, and I do consider them to be alternative, I think that can be a valuable way to get exposure to underlying real assets, in this case, real estate. MLPs, a good way to get underlying exposure to natural resources, especially the energy sector. And a third major category is private equity. There's another category I haven't even talked about, which is structured products. But the third category of private equity, you can get exposure to that in a investor-friendly format through things called business development companies. It is difficult still for the ordinary retail investor to get exposure to private equity the way that the large institutions get exposure, and that's one of the reasons that I probably haven't emphasized that in this discussion. A lot of the major leveraged buyouts and venture capital opportunities are really primarily accessible to very large institutions who are very experienced in these matters, and they have great connections and access. There's not as much available to the individual investor. I think that's something that's going to change. I think in the future we're going to see the mutual fund concept being applied to more and more alternative investments. It can't be applied to all of them because one of the things that these mutual funds offer that most limited partnerships do not offer is liquidity. When you buy an alternative investment-oriented mutual fund, you have very good liquidity. If you want to get out tomorrow, you can get out tomorrow, and it's not a big problem to the firm. Some alternative investments are very illiquid, and they don't fit inside of that structure. So I think that the landscape will continue to change, but right now I'd say some of the major places to invest into alternative investments would be to use these new alternative asset mutual funds, real estate funds, MLPs, and hopefully and maybe some business development companies. And hopefully in the future we'll have more opportunities. Well, market neutral funds have as their purpose, and it's not that difficult to do, is to make sure that they have the same exposure to bullish positions as to bearish positions. In other words, a bullish position would be a long position where you're betting that the stock is going to go up, and a bearish position is a short position where you actually make money if the stock goes down. So an equity market neutral fund, A, is focused in the equity or stock market, and B, is neutral in its exposure. It doesn't matter whether the stock market goes up or the stock market goes down, because their longs and shorts are balanced. Well, if their longs and shorts are balanced, then how do they make any money? And the answer is they make money by being skillful and being long those particular stocks that are going to outperform the index and being short those stocks that are going to underperform the index. They get this what's called double alpha, this chance to make money if they're right about which stocks are underpriced, and they're also able to make money by short selling those stocks that are overpriced. Their performance is just going to be as good as the skill of the investment manager is, and some of them are skillful. Now that long shorts, that neutral strategy can be applied to other sectors as well. You can get, you can do that with regard to interest rates and others. When we talk about a long short fund, we're talking about a similar product, but it does not have as its goal to be balancing the long positions and the short positions. It is not ordinarily equity market neutral. In fact, most of them are biased towards being long much more than they are short, and long more often than they are short. So a typical long short fund might have an might have an exposure, perhaps 50% of the stock market, which means that in a very strong upward market, they'll trail the market, but they should make a positive return. In a very bad market, they're going to go down, but they shouldn't go down as much as the market. Now, these long-short funds, it's very hard to be very specific as to what they are because they vary so much. But of course, they're still trying to do the same thing. Go long the assets that are going to go up and go short the assets that they think are going to underperform. But they tend to be net long, and some of them have not performed well lately. It's been a difficult sector because a lot of the methods that they've been using to try to pick the winning stocks and avoid the losing stocks, or to short sell the losing stocks, have not been working very well. And it's tough to evaluate a manager. Stock picking is a very hard thing to do. You know, you don't want to judge somebody on the basis of a very short-term return history, but some are doing well and many are doing poorly. I hope that explains the difference, where the biggest one just being that long-short funds tend to have a net positive exposure to the stock market, where properly done an equity market neutral funds should have no correlation, no dependence on the overall direction of the stock market. That's great. I actually published a paper on this, and a lot of people will tell you that owning 10 or 20 stocks is good enough, and that's not true, in my opinion. Owning lots and lots of stocks is what creates a well-diversified portfolio. 50 or 100 or more stocks actually give you increased diversification benefits. Now, how much do you put into an individual asset really varies, and the belief that most experts have, and I certainly understand and appreciate, is the idea that the amount that you should put into each stock should many times be based upon how big that stock is. So if we have a huge stock like Exxon or GE, you would put more money into that stock than you would a very small company. So to me, if you're investing in at least 40, 50, or 60 stocks, or hopefully 100, by using mutual funds, you can get this exposure very cost effectively. Then you can spread your money around so that even the biggest stock that you might have in that portfolio, like an Apple computer or a GE or an Exxon, is still going to be less than 5% of the portfolio. I think that there's no need to go beyond 5%. When you're trying to seek diversification, you should be less than 5% in any particular stock. I'm not sure how modest that is, but $8 to $10 million. But as I mentioned in the presentation, there are some publicly traded vehicles. When I say publicly traded vehicles, that's to simplify mutual funds or mutual fund-like products. These are products that you can buy and sell from mutual fund companies or through even trading on the New York Stock Exchange. There are mutual funds that do give you exposure to private equities, and I mentioned business development companies, BDC, and there are maybe 20 of those or something like that trading in the United States. But that's not the sort of exposure that we think about when we think of leveraged buyouts or incredibly state-of-the-art venture capital outfits. I think that you can get other exposures by investing actually directly in the firms themselves. There are private equity firms that actually trade on the New York Stock Exchange, and that's another way to get an exposure. What you're really doing is buying a company, a private equity firm, that in turn runs a number of private equity funds, and to some extent you're getting the exposure. But what we find is that when you buy your private equity holdings through the stock market, which is what I've been talking about there, you tend to pick up the risk of the stock market, where one of the main reasons to be in the private equity space is to avoid the risk of the public stock market. So at this time, I think the opportunities for a modest investor of $8 to $10 million are rather limited in the private equity space. I think you need to get up closer to 50 million to begin to run the sort of program where you can buy into these private placements. And that's a very sophisticated sector of the market. You can't forecast declines, a financial crisis and a decline like we had, even if you had some ability to foresee these and forecast these, you certainly wouldn't want to bet the ranch on these things, bet the farm on these things. So the major institutions, did anybody expect of the financial crisis to unwind as drastically as it did? And of course, some people may have forecasted that, but they've also forecasted declines that didn't occur. So we can't foresee the future perfectly, and we don't want to take huge bets on whatever abilities we do have to see them slightly. So they didn't see it coming, number one. Even if they saw it coming, it's not clear that you can that the sort of deals that they were involved in that they could get out of immediately. Circling back to this private equity discussion, these large private equity deals that are done with private limited partnerships, you can't get out of those quickly. In fact, you not only can't get out of them, they can continue to require you to put more money into them. The private equity, the private equity space, the private equity space with private limited partnerships is something that they were heavily involved in, and it's a space that is difficult to get out of and is quite dangerous. And I think that's one of the areas that they were heavily involved in that you're not involved in when you're buying most of the products that I've been talking about. Yeah, that's REITs. It stands for Real Estate Investment Trust. And these are great products. They're a lot like a mutual fund. But one of the differences is that whereas a normal mutual fund has stocks underneath them that can be bought and sold very quickly, real estate investment trusts have real estate such as office buildings, retail, apartment buildings, industrial sites as their holdings, and they can't get in and out of them quickly. So I talked earlier about the idea that REITs are have some good way to access real estate. Well, they're going to go up and down with the stock market, but as whoever asked this question knows, they also tend to be kind of sensitive to interest rates. And if interest rates soar, then real estate investment trusts are going to probably drop substantially in value. Now, first of all, I would point out that I'm not convinced that interest rates are going to soar. Amongst most people, I would say that I'm actually slightly below, I have slightly lower interest rate expectations than most people. I think that, we all fear that inflation's going to come storming back, the Fed's going to tighten, and interest rates are going to soar back up to their more normal ranges of 4, 5, 6, 7%. And that's very possible, and that's why we want to be careful. But I actually quite strongly believe they're not going to go up that much. They could, but I don't think they're going to go up that much. And the reason is I think there's so much money that people are so anxious to get out of the stock market. The Dow Jones is above 18,000, and there's a lot of people there that I think that are saying, oh, if I could just take my money and put it in a safe place and get a decent return. Well, you can't do it. If you take your money and put it in money market mutual funds or short-term CDs, you're actually going to earn 1% or so. You're going to pay taxes on that 1%, and then the money's going to disappear at a rate of 2% due to inflation. So I think there's a lot of cash, there's a lot of investors on the sideline in stocks that are very anxious to try to get some attractive bond yields. And I think that as those bond yields begin to pick up because of possible inflation or Fed tightening, I think you're going to see these people come in and buy those bonds, driving the interest rates back down. So I don't think interest rates on average are going to go up that much. So I think that REITs are a good place to put your money. Why? Well, first of all, I'm not bearish about either bonds or stocks. I'm just moderated in my views. But I think they offer diversification, because if equity markets go down, REITs will go down, but they probably won't go down as much as the stock market. And if bonds go down, then REITs will go down, but they probably won't go down as much as the bond market. They help to diversify you. It gives you exposure to both of those, and it has underlying properties with reliable rents and revenues that I think will do well in the worst of economic times compared to the other asset classes. That's the reason to be in REITs, even though obviously we expect interest rates are more likely to go up than they are to go down. But that was a good question as well. I hope my answer was helpful. All right. Well, as I indicated probably before that, after that question was asked, that I do expect interest rates to go up, but I expect them to go up less than most people expect them to go up. So I expect bonds to perform modestly. With equities, we're at a Dow Jones of 18,000. But when you look at that diagram that I began with about how much stocks go up over the past 200 years, we still want to be in stocks. Even at 18,000, we want some of our money in stocks. The U.S. stock market has performed especially well. And I'm really bullish on the U.S. stock market. I think we have an incredibly creative economy in this country, and I think it's going to continue to do well. But with the U.S. stock market so high relative to international markets, even though I'm very bullish about the U.S. economy, I think that that is more than priced into the stock market valuation levels we see. So I believe that having a good international exposure is important at this time for the purposes of diversification. I don't expect the global economy to outperform the U.S. economy, but even if they performed equally, you're going to be better off in the international stocks because they are more attractively valued than are the U.S. stocks. So one last point on this international versus domestic stocks. The typical American puts little or modest amounts of money in international stocks, and the typical person who lives in another country, such as France or Germany or England or Japan, puts a relatively modest amount of money in the U.S. compared to what they put in to non-U.S. countries. That's called the home country bias, and I think it's dangerous. If we were to ignore the home country bias and forget that we're Americans for a few minutes, we would, to be perfectly diversified, we'd probably only have 35% of our money in U.S. stocks, and we'd have 65% in non-U.S. stocks. That's really the appropriate balance if we're not U.S.-centric. Now, I understand being U.S.-centric. I think it's appropriate to be U.S.-centric. But should we really be putting 80 to 100% of our money into U.S. stocks and only 0 to 20% in international stocks, especially emerging markets? And my answer to that is no. I believe that we want to move towards more of a rational level of diversification between those two alternatives. And I even would think it's reasonable for investors to put as little as 40 to 60% of their money into U.S. stocks and to put the other 40 to 60% into international stocks. I'm talking about the percentage of your money that you have in stocks, not the percentage of the whole portfolio. I think that's a bit too aggressive for some investors, and but I certainly believe in this international diversification and not being so U.S.-centric that you keep 90 to 100% of your money in U.S. stocks. I'm just thank the people for tuning in and listening, and let me know if I can answer any other questions. I'm always available.